Okay, this is chapter 2, and we're gonna work on the first part of chapter 2. Hopefully this is just a review. I am not planning to spend a lot of time here. This, you should have seen this in accounting. Yet, I'm gonna be reiterating this a little bit since we needed to do chapter 3. So we know that there are 4 basic financial statements: the balance sheet, income statement, cash flows, and retained earnings. So this is what accounting, this is what we have so far in the books is letting us know about the state of the corporation, right? This is past performance, right? If you are working in finance, you will use this information in order to make future projections. However, accounting is based on the past. So balance sheet is where the corporation reports assets, liabilities, and equity, right? Assets is everything you have. It goes on the left side and it's going to be put in order of liquidity, right? How easy it is to be changed into money. Liabilities to the right in order to maturity, and equity goes last and it will never expire, right? So this is an example of a balance sheet. We have our assets right here: current, fixed. Current is everything in the short run, fixed, greater than 1 year. All of these are sorted based on maturity, right? Liabilities on liquidity, sorry. Maturity are these ones in here, right? Liabilities and equity. Liabilities is everything we owe. Equity is everything that our stockholders have put into the corporation. So current assets, as we mentioned before, they can be converted into cash within a year. We have cash, accounts receivable, inventory. Fixed assets, on the other hand, it's something that we can touch, right? Well, we can touch. Some of them we cannot touch, like patents and trademark, right? We talk about Coca-Cola, their brand and their formula. We cannot really touch it, but it's a very big asset, right? How long should we expect them to be useful for? For more than 1 year, for sure. So liabilities is what we owe, right? What do we owe within a year? Well, accruals, wages and taxes, accounts payable, notes payable. Long term is more related to bonds if you have corporation, right? Or long term debt. Equity. We have several types of equity. Now, preferred stock is you are quote unquote part owner of the firm, yet you have preference in receiving dividends. We don't think of them as pure stockholders. It's more like a combination, and they are not pure stockholders. On the other hand, common stockholders are the ones that actually own the firm. Common stockholders are residual claimants. That is, once everyone else gets paid, they get paid at last. They get paid at last. And then retained earnings is the savings of the corporation. We all need to have savings. It's always good to have savings. Now, things that we need to look when we're analyzing a balance sheet. How do we account for depreciation? There's a lot of ways to accounting for depreciation. How much net working capital do we have, right? We can have a lot of net working capital, not that much. By the way, net working capital is current assets minus current liabilities. Every time we're going to take a new project, we might need to have more net working capital. We might need to have more cash. We might need to have more inventories. Therefore, that is one of the main points of the balance sheet. Are we financing our assets with debt or with equity? Are we writing bonds? Are we getting loans? Or are we getting more stockholders, right? Now, this last point is very important. Book value and market value. Book value and market value. Book value is what your books say that you're worth, whereas market value is what the market says you're worth, right? Think of tickets to go and see and watch the Super Bowl, right? Book value is whatever is printed on the ticket, right? I'm going to pay $500 to go and see the Super Bowl. Does that mean that I can sell my ticket for $500? Probably not. Probably can sell it for way more. Why? Because the market value, that is the people that are willing to buy that ticket, there's a lot of people and the market value is going to go up. It's going to be pushed up. For depreciation, let's talk a little bit about depreciation. So in accounting, a lot of corporations are going to use straight line, right? This is how much it's worth, how much am I supposed to be getting back, divided by number of years, right? For tax purposes, though, some corporations will use makers, accelerated depreciation, right? You get more depreciation at the beginning, therefore your profits go down, therefore you pay less taxes, right? Net working capital, we talked about this. It's how the ability of the firm to pay its obligations, right? Healthy firms have positive net working capital. If you have negative net working capital, it means that in the short run you cannot pay what you owe. So that's very bad. We said they are liquidity is how easy or how quickly we can convert our assets into cash at fair market value. That's a very important thing you need to know. Fair market value, that is how much can we get being fair, right? So cash obviously is the most liquid asset. It's already into cash. Inventory is the one that is the least liquid of the current assets. Fixed assets are not liquid at all, right? Um, Liquidity pros. Well, you can get a cash really quickly. Cons, you don't get a lot of return, right? Fixed assets, you don't buy fixed assets to make quick money, right? You buy fixed assets to make a profit in the long run. So, what's the difference or what's the benefit between debt and equity, right? Um, if you have a lot of debt, well, probably stockholders can magnify their returns, right? Debt holders, they have a fixed return. I mean, think of debt holders and stockholders. Debt holders don't have a lot of they don't have a lot of risk. They do have a little bit of risk, but they don't have a lot of risk. They get paid first. They don't get paid that much. Stockholders get whatever is left, right? Um, if you have a lot of debt, well, you might have to pay a lot of to debt holders. Yet their payment is not that big, right? So you can magnify the return of your stockholders. So that is all of the return preferences. Book value, as we mentioned before, it's whatever it says that whatever your accounting says that your corporation is worth. Market